Lesson 16, Understanding Cycles Without Fear. Let's talk about what scares investors, market cycles. What if the market turns? What if prices drop? Here's the truth. Cycles don't destroy investors. Overleveraged debt does. Markets rise, markets fall, that's normal. What hurts people is buying too thin, depending on appreciation, and having no margin for error. So in this lesson, we're not predicting the cycle. We're learning how to structure deals so you don't have to fear it. Real estate doesn't move in a straight line, it moves in phases: expansion, peak, contraction, recovery, and then it repeats. This isn't new, it's not mysterious, it's not random. Every market in history has moved through these same stages. The mistake investors make is thinking the current phase will last forever, but it won't. Expansion feels permanent at the top, contraction feels permanent at the bottom, but neither is. Cycles are normal. The key isn't avoiding them, it's understanding where you are and structuring accordingly. Cycles don't destroy investors, over-leveraged assets do, thin margins do, forced selling does, bad structure does. If your deal only works when everything goes right, you're exposed. When rents soften or rates move, you don't have time to wait it out. You force to act, and forced decisions are expensive. The cycle isn't the problem, the structure is. There are really two types of buyers. The appreciation buyer is betting on prices going up. They need good timing. The cash flow buyer wants the property to pay for itself. They need structure. One depends on the market cooperating. The other can survive if it doesn't. If your deal only works when values rise, you're exposed. If it produces income, you can hold through the cycle. And holding through the cycle is where real wealth is built. Let's stress test this 4 unit. We paid $1 million. It required a 35% down payment just to make it work. It's a 10.96 gross multiplier and about a 6 cap. On paper, it cash flows $1,859 a year. Now apply mild stress. If rents drop 10%, we're negative 7,261. If vacancy doubles from 5 to 10%, we're negative about 2,700. That's thin margin. Yes, over 10 years at 3% growth, you might collect around 21,000 total, but the cushion is awfully small. Now let's stress test this 8 unit example. Same $1 million purchase, but this time we only had to put down 25%, not 35%. And it trades at an 8.3 gross rent multiplier. Stronger yield, better structure. It cash flows about 13,000 a year. Now apply the same stress. If rents drop 10%, we're still positive 3,400. If vacancy doubles from 5% to 10%, we're still positive about 7,400. Why? Because we underwrote 5% vacancy from the beginning. There's cushion built into the deal. And over 10 years, growing that cash flow at just 3%, you collect roughly 153,000 in total income. Less money down, stronger cash flow, more durability. That's the difference structure can make. Let's tie this together. A cap rate is simply income divided by price. So when you buy at a 5% cap, you're accepting a 5% return on your investment. Now think about interest rates. If mortgage rates rise 1%, investors now need a higher return to justify buying. If debt costs more, a 5% return isn't enough anymore. So the market adjusts, cap rates rise, and when cap rates rise, prices fall. In our 4 unit, we bought at about a 5% cap. If rates rise 1% and the cap moves to 6, the value drops about 161,000. That's not fear. That's the math of higher required returns. Now let's flip it. When interest rates fall, buyers can pay more. Lower borrowing costs mean investors accept a lower return. So cap rates drop, and when cap rates drop, prices rise. Our 4 units started at about a 5% cap. If rates fall 1% and the cap moves to 4, the value rises about 247,000. The 8 units started at a 7 cap. If rates fall 1% and the cap moves to 6, the value rises about 166,000. Both go up, but the lower cap property moves more. The more you pay for income, the more sensitive the value is in both directions. Let's step back. Since 1970, inflation has averaged about 2 or 3% a year. It's not dramatic, it just keeps moving. And over time, rents adjust. Income rises and value follows income. Cycles create short-term swings. Inflation creates long-term lift. Most investors aren't saved by perfect timing. They're carried by time. If your structure lets you hold, inflation does much of the work. You don't need perfect timing, you need durability. Now let's look at 10 years. A 4 unit is often in a stronger location, lower density, better neighborhood. So let's assume 5% annual growth. The 8 unit is denser, more income focused. Let's assume 3% growth. After 10 years, the 4 unit's value increases about 620,000. The 8 unit increases to about 343,000 extra. So yes, the stronger location compounds faster, but now look at the cash. The 4 unit only generated about 21,000 over 10 years. The 8 unit generated roughly 153,000. Less appreciation, more income, different strengths. One grows faster, one pays you more along the way, and that's the real comparison. No one consistently buys at the bottom. It's clear in hindsight, never in the moment. And waiting for perfect timing often turns into never buying at all. Cycles will happen, they always have. But long-term ownership smooths the cycle. Time absorbs volatility, and structure gives you the ability to stay in the game, because in the end, timing is uncertain, but structure is intentional. You don't control the cycle, you don't control interest rates, inflation, or timing. What you do shape is your leverage, your structure, and your discipline. Markets recover, but weak structures don't. Wealth isn't built on perfect timing, it's built on durability. If you'd like to run these numbers yourself, the follow along calculators link is in the description. Stress test your deals. Confidence comes from good structure.